But let's start off with extensions and deductions with tax brackets and standard deduction. This is for both of you since this has touched both of your worlds. So, Brad, starting with you, tax brackets. How have the tax brackets changed, and what is exactly does that mean for your clients in terms of high income earners as well as business owners?
Yeah, so in terms of how tax brackets have changed, this kind of gets back to what I was just saying a second ago, is that it's not a change, right? So what we've got is we've got an extension of the tax brackets that we have had since 2018. Now, these are improved over what we had before 2018, which was, what the Tax Cuts and Jobs Act did. So what we get here in this new bill is we get to keep what we've had for the last, what's that, 7 or 8 years. We get to keep the 10, 12, 22, 24, 32, 35, and 37% tax brackets. Instead of what we were going to get if they didn't pass this bill, we were going to go back to 10, 15, 25, 28, 33, 35, 39.6. Summarize that, we've got far more income going into lower tax brackets than what we would have if this had not have been passed. And that it benefits everyone from the high income earners all the way down to the lower income because of the brackets being expanded. There's more income fitting into those lower brackets. And then also because of the addition of some of those lower brackets, the 12%, the 22%, the 32%, and then the top bracket only being 37 instead of 39.6. So overall, that's what we get. We get to keep kind of expanded lower tax brackets. We get to keep the extra lower tax brackets, and there's more income for everyone falling into lower tax brackets than there would have been if this hadn't passed.
Okay. And then are there any types of clients who would be led to believe they're going to get a huge benefit, but actually not necessarily, maybe not as much as they think? Any like, because there's a lot of narratives out there, right? Or is there any narrative someone could easily fall for and be like, oh, this is going to be great for me? Well, yes
Yeah.
and no. Any examples like that in in your research?
Honestly, I haven't seen too many clients asking me about the bill yet, which is kind of interesting,
Hmm.
and what the changes are. But I haven't seen too many of that where it's going to be, hey, I'm expecting something major and I end up with really no benefit. Again, it kind of goes back to I think there might be some people who do get caught in that where they think, okay, the tax bill passed, so what's the benefit for me? And they kind of end up status quo in the same spot. And again, that was, in my opinion, one of the biggest benefits of this bill is that everything's kind of remaining the same. So it wasn't this kind of huge moment where everyone's getting a cut. It was more like preventing most people from having to pay more. So I think that's going to be the biggest surprise is, hey, how come nothing changed when we just had this huge bill pass? And it's like, well, that's actually a good thing because the change that was coming was more taxes if they didn't pass it.
Yeah. Yeah, and I think we've all had enough taxes. I think people in general are sick of paying taxes, or at least, would like the tax money to be spent and appropriated a little bit differently. But Andrew, if more people having more money in their pocket and with either this the same or just a little minor changes with the tax brackets, how does that affect how you drop a financial plan? The idea of asset allocation or withdrawal strategy. So even myself, right? I got really deep reductions. If I get my tax bracket is kind of, whatever, does that impact how you and I, as advisor and client, can impact my business finances? Like I want to still do a retirement account for my business income towards the end of the year. Can a change like this and new policy like this, we've been saying the course, impact how you drop a plan with your clients from a tax perspective?
Yeah, absolutely. The biggest thing is now we have certainty. The last
Mm-hmm.
2 to 3 years, a lot of my planning's been, hey, let's do these things now, like Roth conversions, taking advantage of the qualified business income deduction for the self-employed and business owners. Let's do them now before 2026 in case we revert back. So a lot of our planning was very proactive measures. What can we do now? But even now that we finally have some certainty, we're still going to, okay, what do we need to do going forward? So for a lot of people, it may be we continue to do Roth conversions. For the self-employed, we continue to see where we can maximize qualified business income deductions, as well as other write-offs and things that are available to them. So there's definitely a lot of factors now that this law is done and we know what to expect going forward. But I think definitely a lot more opportunity as well. And that's a good thing, right? Is you definitely want to provide value for clients. And I think now we can still provide value like we were doing. But there's a lot of nuances that, people like Brad, I have to rely on from the tax perspective to make sure, like, hey, we're doing this. Is this still the right thing to do for a client and not just be on autopilot thinking, oh, we're good, nothing's changed.
Right. Right, absolutely. And you said the C word, clarity. Clarity is so important just in anyone's finances, right? You want to know how much money you owe, how much money you have coming in, and the markets are no different. Tax strategies and tax planning and tax brackets are no different. Clarity is probably the most important thing because then you actually know well, you have a better idea of what's going to happen. And you even mentioned earlier, the most important thing in this bill is that it passed now in July as opposed to the end of the year in December. So those extra, like as the end of Q3 heading into Q4, what does that extra time really mean for you as an advisor? And even Brad, to you as well as a tax strategist and someone who works in taxes, that extra leeway of clarity and understanding, oh, we have 5 more months in the year, so we're not scrambling. How does that change what you do and how that impacts your clients? So, Andrew, you first.
Yeah, the big thing is it gives us a little bit more runway than we thought we
Mm-hmm.
might have, but it also can help create now multi-year plans or multi-year strategies because some of these things, like Brad mentioned, aren't effective until 2027 or they may expire in 2028. So there's a lot of things where now we can say, okay, for the next few years, here's what we have to work with, and we know pretty well. Again, I'm not going to say guaranteed because there's no guaranteed with tax law, but pretty sure that nothing will change at least until 2029, if we get a new administration. So that gives us a lot more runway. But the big benefit too is, how some things are structured with standard deductions versus itemizing, and even the state locality clients live in, like Will, yourself in New Jersey, a high income state versus some of my clients in Florida, like Brad, where you have no income state taxes. All those things matter too. And it's nice that we have several months where we can look at some provisions, plan ahead, and it's not just this mass chaos of either like, oh, we did things and we shouldn't have done them, in January, or at the same time, like, hey guys, we have to meet before Christmas Eve because we got to get this done. So I'm very thankful to have several months to work. And Brad, you might be able to appreciate that too with your.
Yeah. Yeah, I mean, I definitely agree. It's huge when they actually. I don't know. I started tax practice in 2008, and so we had some Bush cuts back then, and we had some Obama stuff changing in there, and it seemed like a lot of those Bush cuts were set to expire as well. And at the end of every year in December, we just kept getting these 1 year extensions, and that was like 2008, 2009, 2010, and it was such a pain because you didn't know what was going to happen. And so getting it in July, again, like you said, everyone kind of thought, okay, maybe we'll get this in December or something. Okay, well, bonus depreciation, that's back for 2025. You've got some R&D expense stuff that applies to 2025, standard deduction, the tax brackets, like all of these things are in this 2025 year. Now, some of that wasn't set to expire, like QBI and stuff, wasn't set to expire until the end of 2025. But there's several things that changed related to 2025 too. And now instead of just those happening in December, and we're like, oh, okay, well, I guess we get this benefit. We actually have it and we know about it during the year. And that just, it opens up more planning for the current year as opposed to just looking forward, starting in 2026. So yeah, huge benefit. Glad that they actually got something out mid-year instead of at the last minute, or worst case, right? They don't get it out until early next year and then retroactively do it, which they've started doing lately too a few times. Where,
Oh God.
with unemployment benefits, when they came in and
Yeah.
said, "Hey, unemployment benefits aren't taxed in like 2021, 2022." They did that after we had already filed returns with unemployment benefits on them. Like that was the first time I'd ever seen that before. So
So
I'm
would you
glad
have to
they
like do
didn't keep.
amended returns, or is that just like, all right, if it's wrong, we'll try again next year?
Was that?
Like it's like, because if they change that retroactively, would you have to then submit an amended return, or is this like, well,
Well, so that one,
try
in
again
that
next year?
particular situation, they said, don't amend the return. The IRS fixed it, right? So I was like, hey, we'll refigure it as if you're unemployed. But, okay, I mean, I've already filed, 25% of my tax returns with these unemployment benefits on there. And the
Yeah.
people, then the IRS takes 6 to 8 months, right? They did adjust it. They get them their refunds. But yeah, it was, but then there are other times like the research and development, which they put into this bill, that goes back to 2021, and they gave you the option to file amended returns. So there are situations where that might happen too.